Hello and welcome to your global markets technical outlook for the end of, well, it's not the end of the quarter, it's actually the middle of the quarter, so you're getting a bonus 0.5 with this quarter 3.5 update. Normal disclaimers apply as we take the pithy quote this time from Spike Milligan, who says money can't buy you happiness, but it does bring you a more pleasant form of misery, as we get stuck straight into the US stock market. And on the monthly log scale chart, well, we can see it's steady as she goes. We're still in this very well behaved bull trend, which has now gone above 7,000, and as you can see just about at the top of the chart there, 8,000 is not very far away. So no sign of any increase in volatility at this stage. It's certainly not on this time frame. And if we dig into the weekly chart, we can see that 8,000 is not very far away at all. We're currently sitting at about 7.5. However, we are just starting to ride the top edge of the range, so perhaps just a little bit short-term overbought, let's call it. But otherwise, it's a very well-behaved bull market with higher highs and higher lows, and you can't see any more than that. On the Ichimoku chart, we can see that the Chiku span and the price both above the cloud, so that tells us the market is definitely bullish, and we see the cloud support around about that 6,100 to 6,700 area. So if the market does come back, and it's a long way back, that's 1,000 points back, then we would expect to see support show up as we did back here in early 2025. So let's dig into the internals and see if that's backed up by what's happening under the hood. If we look at the bullish percent index first, the headline number is that it's at 70. So 7 out of 10 of the stocks in the S&P 500 are bullish. That's a very healthy number. That tells you that there is a lot of buying going on to keep this market afloat, and that the buying is very broad-based. The only thing I would point out is just a hint of divergence, but that's not unusual on these charts. We do see divergence taking place over long periods before the market has a major reaction to it. 12 to 18 months is not unusual for this style of diversion on these charts. But the number you need to keep your eye on is the one on the right hand side of the chart, which is 70, and that is very healthy for a bull market. And as we look at the stocks above their 200-day moving average, you can see that just the similar sort of hint of divergence creeping in there as the highs reduce. But the measure is still 61%. So 61% of stocks above their 200-day moving average across the whole of the New York Exchange. That's still a reasonably healthy number. I wouldn't be too concerned about that. If we start to see highs being printed in the 50s, that would be a bigger concern. But for now, this doesn't seem to be anything too much to worry about right now. Discretionary versus staples, however, is starting to show a little bit more meaningful divergence here, as we're seeing these lower highs come in as the market makes ever greater highs. This might be a canary in the coal mine, just showing that spending in the economy is slowing, especially on discretionary items versus staples. That can have a longer term impact on the overall economy, and stock market tends to lead that. So we'll see how this plays out. It's kind of more sideways really after that initial move lower. So we'll see how that plays out. But yeah, just a hint of divergence on this chart at the moment. On the semiconductors, again, just a small hint of divergence at the end there, but overall you can see this chart is just pulling everything up. Of course, this speaks to the big theme in the market at the moment, which is AI chips and so on, which are feeding the AI boom. Data center building and so on is just going crazy at the moment. So you would expect the semiconductors to be doing very well, and they are, and that is having the effect of pulling the whole market up with it. The home builders, however, still continues to show signs of decline when versus the S&P 500. We'll speak a bit later about where we are in the property cycle. This is often a sort of precursor to a move lower in the property cycle, and that can have knock-on effects to the stock market as well. But you can see this has been happening for best part of almost 2 years, and it's not had a meaningful impact on the stock market yet. So the catalyst has not yet happened for that to take shape. And on the advanced decline line, we can see that this is still very bullish. There's clearly money flowing into the market because the stocks that are advancing are outstripping the stocks that are declining. And that's agreeing with the bull market. And this chart kind of trumps all the other ones, because as long as there's money flowing into the market, well, that's going to keep the market afloat in one way or another. On to the relative performance of the three major indexes in the US, and you can see it's the small caps, the Russell, that's leading the charge at the moment, up 23%, the Nasdaq up 17%, and the S&P 500 this time bringing up the rear around about 13%. So having the small caps and the tech sector leading the broader index is generally a good sign. It generally means that it will pull the broader market up with it, because both of those indexes, the Russell and the Nasdaq, tend to be more speculative. So if there's money flowing into them, it will tend to pull the rest of the market up with it. So in effect, this is a bullish sign for the market. Onto the yield curve, and we are still in that normal shape, and you can see it's just from those shadow lines, it's actually just moving a little bit higher at the far end of the curve. Not much movement at the short end of the curve. But this normal shape is a very good shape. It means that risk is generally low in the market. It's cheap to borrow capital and pump it into riskier assets. The switch back from being inverted back to normal doesn't seem to have had any major effect as yet. I mean, that can often be a precursor to a recession. Either we haven't had it yet, or the AI boom is kind of negating it. But for now, I guess all we can do is be thankful that we're in a normal shaped yield environment. On the put-call ratio, well, this kind of still, I mean, as you would expect with the stock market making all-time highs, this is kind of bouncing around down in this so-called bullish extreme area. In previous times, when it gets very low in these extreme areas, it can lead to corrections in the market. But again, we're not seeing that effect just yet, and it does seem to be creeping back up, which means that some of the heat is being taken out of the bullish market itself. And on the VIX volatility index, we can see we're in this very low risk area, which kind of lines up with everybody being bullish at the moment, because all the appetite for risk protection has gone away, and that depresses the price of the VIX, and we end up down in this very low level of 14, which is low-ish, but it can go lower. As you can see, it can get right down to below 12 on occasions, and even down as far as 10. But as long as it's in this low risk area, then the market should be steady as she goes to the upside. Of course, if the market corrects, we'll get an immediate reaction on the VIX, because it is a mean reverting index. You can see every time it gets very high, it comes down. Every time it gets very low, it goes up. So are we at an extreme point yet? Well, we're seeing that short-term overbought situation in the stock market at the moment. Perhaps we'll get a little bit of a reaction of that. Will it take us all the way up to the 20s or the 30s? We'll have to wait and see if that is where we're headed. And the sort of bullish sentiment in the market is certainly feeding into this fear and greed index. As we can see, it's up here about 62. If we look at the time series of it, though, you can see that 62 is not really an extreme. It can get up into the sort of low to mid 70s here before we see any reaction back the other way. So it does waver around this, as you can see, but it's certainly in the sort of, let's call it, upper quartile of where it might be before it reacts to the downside. So definitely everybody on one side of the market at the moment. On to the cycles now, and as I alluded to earlier, we are sitting right at the peak of the so-called 18 or 18.6 year real estate cycle. 2026 is supposed to be the cycle peak as it was back in 2008, 1990, 1972. If you're old enough, you'll certainly remember the last three of these. We are certainly locally here in Australia, we're seeing some roll off of prices in the housing market. That's due to a number of factors, things like interest rates, changes in tax legislation, and so on. Is that enough to precipitate a bear market in the housing market? It's probably too early to tell at the moment. Australia has been famously resilient. But so it would take a look to other markets or a big fall off in other markets around the world for us to be able to make a definitive call on whether we are heading into a real estate bear market. But for now, we're riding the highs and keeping an eye on those home builder prices. On the seasonality, so the S&P 500 annual seasonality, so this is what happens generally in most years. You can see it lines up fairly well so far. We got that big dip into the end of March, which kind of lines up with this one here in February, and then we get this sort of northern summer doldrums where everything just goes to sleep and goes sideways, and we've certainly been in that sort of up and down here, as you can see. Heading into August, we just had a little bit of a move up here. Is that an early one of these up this way, or is this going to fall back and just become more of this sideways action? We'll have to see as the rest of the month plays out. But so far it's a decent enough analog, I would say. And just a reminder, we're here in August. Not much to write home about normally in August. July tends to be a more bullish month. September, as you probably know, a lot of the sort of price shocks come in September, so I wouldn't be surprised if we saw some sort of pullback into September, given that the market's been very, very strong lately. And then, of course, we've got the most bullish quarter of the whole year going into October, November, December, coming after that. The midterm seasonalities is a big fat fail at the moment. We can see here how price would generally go sideways to up coming into the second quarter, and then it would fall down towards the midterm elections, which are actually the very start of November, but the 3rd of November here, and then rising out of the back of that. But we're not seeing that at all. We're seeing the opposite. In fact, we're seeing the market move up and up and up and up, and that is very curious, isn't it? So again, is it the AI story that is overriding everything at the moment, or is there something else going on at play? But the presidential cycle is out of sync for this year. There's no doubt about that. And the decade cycle is also out of sync a little bit. It's been more of an up year than a sideways year, as might be implied from year 6 on this chart. So the cycle's a little bit all over the place at the moment. Switching now to the Australian stock market, on the monthly chart of the ASX 200, we can see it's bullish, and not only is it bullish, but it's started to accelerate a little bit at the end here. And you can see it's made for that 9,000 level, and it is already over that level. Now it is this last bar is not yet closed, so we can't say for sure whether this is going to hold above that level, but for now it's looking pretty good. And if we switch to the weekly chart, you can see that it took 1, 2, 3, 4, 5 attempts to get over that 9,000 level. It's now held closed above it for 1 week. Are we going to get another close for this week above it? This last candle is not yet closed. Or are we going to get another failure like we did back here earlier in the year? We'll have to wait and see, of course, but it is looking a little bit more bullish. We got this kind of double bottom or inverse head and shoulders, even if you like, which tends to be quite bullish. There's definitely appetite to go higher. As you can see, we're getting higher highs and higher lows across this chart. So I'd say the balance of probabilities favors the upside, with all else being equal. And the Ichimoku chart kind of backs that up. We're definitely bullish with the Chikou span and the price, but actually finding support in the cloud here, as you can see. I do bang on about the cloud being support, but here you can see some quite good examples of it as it finds support into that cloud and then pushes higher from there. The cloud support currently sitting about 8,500 to 8,700. Having a look at the ASX 200's peers, and the Nifty, the Indian index down there at -6, so not having a great year over there. The Hang Seng just sort of going pretty much flat at -2. The ASX up about 6%, 6% that is, and the S&P up about 13 as we saw earlier. But it's the Nikkei that's been doing all the running once again, and it's up 34%. So big move up there in the Japanese index. I don't often show this chart, but it's an interesting one. This is the ASX 200 versus the S&P 500. So the right-hand axis is the number of units you get of the ASX 200 for every unit of the S&P 500, and you can see it's been dropping at the start of 2024. You could have got 1.6 units. Now your ASX is only worth about 1.2 units. So a lot of this effect might be down to the stronger Aussie dollar, which we'll have a look at in a second. But it's worth keeping this in mind if you're holding exclusively ASX stocks and you're not exposed to the US index at all. On to the currencies, and on the US dollar index, well, pretty much sideways. It's sort of been bouncing around in this sort of 96 to, let's call it 101 area for the last probably year or two. It doesn't look like it's ready to break very much higher or lower. You could make the case that it came into the consolidation from above, so you know the next likely outcome is a push lower, but it doesn't seem like it's got the appetite for that just at the minute. So sideways I would call this for the US dollar. The Aussie dollar, however, has been a little bit more bullish. As you can see here, it bounced off that 0.6 level, which is obviously a key level from a couple of key moments in the past, the GFC being one of them, and it's made its way nicely up to 0.7 there. So that speaks to that, you know, strength of the Aussie versus the US dollar. It's now just kind of consolidating around about that 0.7 area, and again, you would have to give the benefit of the doubt to the upside once it's had time to breathe in this area here. On the euro, well, very much sideways. I mean, there's no other way to sort of describe this. It's trapped between this 125 and 105 area. It did break out of this sort of descending triangle, but it's kind of just sort of moseyed along sideways and not really gone anywhere. It's kind of a mirror image of the US dollar, as you would expect for the two biggest trading currencies. British pound, much the same actually. It's gone nowhere. It's bounced between with this 1.2. My line seems to have disappeared, but the 1.2 level and the 1.45 level is the consolidation area for the pound here. And the Japanese yen in the news a bit lately as the Fed and the ECB both tried to buy up some yen to protect it. But I think that little green candle there was probably the effect of that, which is, obviously, you can see, not very much. So the Japanese yen remains very weak. This 0.0062 level is a key level going way back. So if it lost this, that would be very significant, and that's probably why the efforts are ongoing to try and save the plucky little yen. And Bitcoin, well, the Bitcoin bear market continues to unfold. Lower highs, lower lows. There's no doubt about that. It's really sort of stuck between this 52,000, I should say, and 74,000 areas, US dollars, that is. It is worth remembering that this is a volatile market. It does have these huge up and down swings. It's still quite a young market. the buying point, if you like, for the last cycle was in this very area before we got that move higher. Admittedly, it did come in to the pattern from below. This time, not so much. It's actually come in from above. So, but if it's able to find support on that 52,000 area, then that might be significant enough for it to make a move higher. So, worth keeping your eye on that area there. And wrapping up on the commodities, well, oil continues to be volatile, as you might expect, with the situation in the Middle East not yet resolved. From a technical aspect, though, it was a picture-perfect break, contra break, if you like, from this descending triangle. It broke to the upside, which caught all the traders who were short offside. The short squeeze pushed it higher, and then we got this amazing touch of the upside, the backside, if you like, of the trend line, and then another move higher. So it's been a very technical market despite the volatility. But it does just continue to wiggle about between this, let's call it 75 and 105 area. And until we get some sort of resolution in the Straits of Hormuz, then I would imagine it will be more of the same for oil at the moment. Copper continues to be bullish. A combination of supply constraints and the green tech revolution continues to push copper higher and higher. It's making new all-time highs just about every other month at the moment, and continues to look very bullish. Silver, whilst it has come back a little bit from those kind of nosebleed highs, it is still looking reasonably bullish at this stage. $50 is obviously the key level. We might get a little ABC back into that 50 area and then a bounce out of that. But still reasonably bullish for silver at the moment, despite the sell-off. And gold's pretty much the same. It's rocketed up here. Don't forget, these are log charts, these silver and gold here. We did have a little bit of a sell-off back to 4,000. It's bouncing off that area as well. Obviously, 4,000's got that sort of round number psychology, similar to what happened at 2,000. So it continues to be bullish despite a little bit of selling coming in the last few months. So just to summarize that, on the US stock market, we certainly remain bullish. The market internals look fairly solid. There's a couple that are sort of looking a little bit dicey, but for the most part, most of the internals are fairly solid. Just perhaps nudging the top of the band there for the moment, and looking a little bit overbought. So perhaps we get a little bit coming off that, or a little bit consolidation, perhaps a bit of a sell-off even. But overall, I would expect dips to be bought into. On the ASX 200, well, still clearly bullish. We're over that 9,000 level. If we can hold above there for a few weeks or a month or two, get a couple of closes above that level, that would definitely give it a lot more stability to go forward from there. On the currencies, most of the majors looking sideways. The Aussie dollar looking probably a little bit more bullish. Bitcoin obviously looking very bearish at the moment. And on the commodities, well, oil does remain volatile. Copper looking very bullish, and those precious metals just pulling back a little bit, but still overall bullish. I wish you well for the next quarter, and good luck, good trading, and bye for now.